Of course, other factors there, including whether the technicals line up as well. It's a big ask. So is it fair to say that this is probably more likely than not a bear market pause?
Well, I think if we look at starting from technicals itself, the US equities have been testing it at 200 days moving average. They have recently hit it, but pulled back, so failing to break above it. Certainly, a break higher would signal like an extension to the rally. But a failure, however, would probably means that we get another leg down in the making in terms of markets. And I think the equity market is certainly testing that at the moment. And I think there's a few key variables that we are monitoring in terms of whether this rally will extend. I think key is really the dollar, because we really need to see a weaker dollar for risk assets to sustain the recovery. But broadly speaking, if you look at the US dollar, it has been rapidly strengthening in the past couple of weeks. In fact, it is now at the highest level since June, May 2022, and major other currencies are also back to their lows, this year's lows versus the dollar. And certainly the Fed Jackson Hole will be quite a key event to watch later as well. Given the rise in equity markets, we have basically seen financial conditions actually easing instead of tightening. So to some degree, we are expecting that Chair Powell may well push back against the ideas that we should expect a dovish pivot anytime soon, given financial conditions actually improved versus deteriorated, which really goes against their current policy stance to really tame inflation and pricing pressure on the next months ahead. So these are the two main key factors. There are also other factors such as oil prices, which will feed into the views whether US inflation is peaking. But net, I think the macro backdrop going forward is going to be quite challenging until some of these factors are being addressed on an ongoing basis.
Mm-hmm. China is the other big factor that needs to be addressed, right? And of course, what a week for them to announce an additional $1 trillion $1 trillion yuan, I should say, in funding. Is this enough to lift animal spirits when it comes to emerging Asia and China in particular?
Well, we are constructive on China. I think unlike many of the other developed economies, China is probably the only other major economies that looks to be easing policies rather than tightening policies and curbing growth. So, to us, the $1 trillion, 19-point policy package is a step in the right direction. They've also cut policy rates, cut their loan prime rate as well. And try to ease more, ease the access to financing by some of the major companies. So to us, it's a direction moving in the right direction for China.
Okay. Audrey, I want to look at oil prices. I had a conversation with a former Fed official while I was sitting out in front of my cabin today, and he was expressing all kinds of concerns and hesitations about the Fed, but one was oil prices. He says, yes, they're down, but there's still odds that they are going to move higher again. There's so many geopolitical factors. There's so much in the world. What do you see with oil prices? And if it does move higher, does that hurt economies? Does it change? Does it make it harder for the Fed to back off?
So energy prices, in our view, will continue to pose upside risk to inflation worldwide, particularly the US as well as Europe. Certainly, we have seen some moderation in oil price lately. That's really a function of concern about demand. But again, if you look at inventory levels, they are still low relative to long-term history, and the fact that we also still have major geopolitical tension elsewhere, whether it's in Russia, Ukraine, obviously Iran. If the nuclear deal does come true, that should be positive for oil supply and maybe resulting in slightly lower oil prices in the short term. But longer term, I think, given the shift, the structural shift to decarbonization and very, very limited capex by major oil companies, we believe that energy prices are probably biased to the upside.
Okay. Dollar topping out. This is very important to many markets around the world, certainly all kinds of currencies.
I think short term, we do expect the US dollar to potentially continue the extension in terms of its recent rally. Obviously, a lot will depend on what Jay Powell say in the Jackson Hole. But what we see here is that they have a key support at around 104.7. A failure to break sustainably lower probably means that they will probably stay in this current wide range at the elevated level for the time being until there are other data points or even comments by policymakers to suggest otherwise. So in the near term, probably biased to the upside rather than downside.